Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results.
So stressful when the world's on fire. Good God. I can't look at this, guys. Like, my strategy is you buy it and you hope that you got a good spot. Yeah, but we all think you're crazy. You don't fight this. No way. The markets are freaking out and you don't think that anything is wrong? Come back tomorrow and I'll lose it all. Should be fun. Hey guys, sorry there, I started the music a little bit early. But hey, we got a NonFarms coming up here in 5 minutes. I'm actually reasonably on time today, so that's good. If you want to know my thoughts on what the NonFarms is going to be this week, you're going to need to go over to the premium Discord, premium being $3. And I have a brief thoughts posted in the threads, in the information forum over on premium Discord. So you can go over there and look, but let's come and look at the charts, see what we got here. It's like current trend is a little bit down in the treasuries, and wow, okay, yeah, so they, you know, after our session, was it after our session? Yeah, or no. So there was some crazy stuff yesterday, right? Like, we're breaking down, and then there was kind of more Israel headlines, and there's kind of a counterplay. But now here in the overnight, we're going a little bit lower. S&P 500 still within the range that it's been in through most of the week. Oil spiking higher again yesterday, and it looks like they're continuing off of that. So again, geopolitical risk coming into oil. Gold and silver still doing okay, but like no big moves yet. Kappa still kind of reeling from this pullback here. And the Japanese yen, okay, well, we had a big down day, you know, yesterday night, but we're okay so far now after that. 101.5 in the dollar. Bitcoin not having done a whole lot. So but when I look at the volatility structure and everything, I see reasons for this NonFarms to be like huge, but I'm kind of not really expecting a huge thing. But you want more detail? I don't know. I shouldn't go into any more detail. Do I think, should I buy or sell? I don't think it's gonna move down. Well, we got 2 minutes, so let's see. And by the way, are you guys all there? I don't see anybody popping in yet. Let's see here. We're here. We do have some. Well, it is pretty quiet, so that's okay. I got it. All right. Well, let's just wait. Like, I have a number that we think it's going to be, but even if we hit that number, I don't know if we're going to get that big of a move. There we go. Hi Uzi. Hi Amir. How you doing? Oh, you know what? Well, let's wait until after the news. But I should also start up the stage over on the Discord. Actually, I can do it right here. There we go. It's not that hard. Okay, here we go.
Block sell.
Ooh. 254. What the fuck? Whoa. Whoa. I was expecting 175 and that was a high estimate and they blew through that. That is a sell. Oh man. That is so big of a sell. I don't know if I can even on sim here find a spot in this. That is a stunning number. That is a ooh. Like the Federal Reserve. Okay, so a few caveats here, all right? The Federal Reserve has kind of already committed to cutting rates again at least 2 more times this year. Some people were still talking about, hey, maybe in November they do another 50 basis point cut, and that would get us to 75 more basis points of cuts this year. There is no way they're doing another 50 basis point cut with the non-farms number being that good. That's insane. But there are 2 more non-farm. There is at least not 2 more. There is another non-farms report before the next Federal Reserve meeting in November. So, wow. Well, until they revise it down to 100,000, right? I mean, if that is another, like, gets revised down big time below 150,000 next month, I'm gonna be so pissed. I'm gonna be so pissed because you're doing it at a super critical junction. Like, man, okay. You get the economy, it's running really hot, and they decide we can't reduce interest rates now, we need to keep them high. And then the reality of the economy right now is actually it's really hurting. Because I think there are some things about the labor market that kind of suggest that the labor market is really hurting. You just caused a recession there with bad data, if that's really what's going on, right? 254. Was that what it was? 254 non-farms payrolls. The median expectation was 150. The whisper number that I was looking at was 175. We got 254. Also, average earnings up a little bit. Wait, where's the average earnings month over month? Yeah, a month over month, spot 4 versus spot 3. What about the unemployment rate? Unemployment rate ticked down from 4.2% to 4.1%. This is just across the board. Absolutely stunning numbers. Stunning non-farms employment numbers. Absolutely insane. Well, you get a pretty big pullback in here. I honestly, I'm not the biggest fan of action like this because you just get, you know, if you make one wrong move, you just get your head chopped off, right? Like it's way too volatile here. And of course there's going to be a big pullback. I don't know, after a move that large, it's kind of hard to like pull back and then go lower. So kind of the opportunities that you get as a retail trader trying to be an informed trader aren't very good in that situation. We've had non-farms where there was enough nuance in the report to read it where you get these counterflows and you can kind of take things, right? But this one is just bonkers. And does not give us a lot of opportunity. Okay, I did start the stage in the paid Discord, so if you guys are over there, and you want to see my screen, my other screen, you can head over there. So I'll just show you real quickly right now. Like, okay, so when you look at like the average seller position, is going to be doing some weird stuff. So I'll come back and keep showing that to you guys, but if you want to just watch it yourself, you can go into the paid Discord and join the stage channel. Let me also take a picture because it's doing some. Well, I'll take a picture after it's done moving around because it's doing some wild stuff. Okay, so now next thing I'm wondering, I'm gonna come over here. Japanese yen. Oh, yeah, that's ugly. That is ugly. This is a problem. So when I look at this, I mean the S&P 500 is popping off. They decided so the analyst expectations and everything were kind of like, if we go below 100,000, then that's kind of like a problem. If we go above 200,000, that's kind of a problem. But everybody kind of expected that it was going to be in the middle. Well, it was 250. So I would have thought that the S&P 500 would maybe pull back on expectations that the Federal Reserve isn't going to ease as much as they thought, sort of a thing. But the S&P 500 is still taking off. Okay. Meanwhile, I look at things like the Japanese yen, and I'm like, that's a problem. Like, the carry trade is on in a big way. Tech stocks are probably going to like that, but this could cause problems for Japan. And if we decide we're not really reducing interest rates, because here's the thing. Something that we have not talked about at all, but is going on, is there's the sovereign credit risk rating for the United States or cost or whatever you want to call it has like jumped up really big recently. So when that happens, it kind of suggests that there's something going on underneath that we don't know about. Like that there is a institution, a bank or something like that that is kind of stressed out, that is being stressed. So some people have theorized that the reason the Federal Reserve is in such a rush to bring interest rates down, including a 50 basis point cut, even though we really only had like 1 bad month of data, is because there's, somebody's in trouble or whatever the deal. Like they know that the health of the banking system isn't very good because the interest rates are so high. Well, if the economy is still super hot, then that's a really big problem for any of those banks that are stressed right now. I don't remember the name of the exact thing. I don't think that it's SOFRs. I think that it's like a credit swap. August jobs numbers were revised higher by 17,000. That's the interesting thing. It's so coming back to the bigger thing, Uzi saying, I refuse to believe the employment data is that good. I'm with you there. But I do not believe that the Bureau of Labor Statistics is like sitting here going, well, we really need the economy to look good for the election, so let's make these numbers be higher by, 150 or how much was it? By 75,000 jobs. Let's make it higher than 75,000 jobs, so that it will look good for Democrats and Kamala Harris and everything. I don't think that they're doing that. What I think is happening is they have a certain methodology, and there's some things about the methodology that I think are not very effective. Like, I can see the analyst estimates and everything being off a lot on non-farms just because it's a very unpredictable number. But when it's like it gets revised down every month, that kind of says that there's something about their methodology that kind of sucks. Because the way that it works is just like in trading, right? If we have a moving average and your moving average is a really short moving average, that means that you're going to get more up-to-date kind of signals. You're going to get more signals and you're going to get faster signals. But that also means that you get a lot of false signals. So if you use a larger moving average, then you get later signals, but they're more reliable, right? And it's the exact same thing with economic data. And so that's what they're doing is they're saying, okay, well, we want to get this information out to the market in a time frame that is the most useful to them. So we're going to put the number out based on the data that we have. And then there are other data sources that we get later that give us an even better picture of what's really going on. And so we revise the numbers 2 times after that. That's what they're doing, right? If you're revising it down every time, then that kind of suggests to me that there's things about your methodology and what you're getting in that first push out that can be optimized a little bit, you know? Let's see here. I can tell you have zero trouble with trading psychology or any of the emotional cliches most people attempting trading are dealing with. How? Question mark. Well, I don't know if that's true. I'm not in a position right now, so I can say whatever I want, right? When I get into a position, I get nervous, and especially if I've taken a loser, I feel that taking a loser really negatively affects a person's ability to make decisions, right? I think though that 2 of the advantages that I have here is number 1. This is kind of just like a game to me, to be honest with you. At this point, this is kind of like a game to me. I think most retail traders, they come in and they're like, I've got to do my best at this because I want to make this my career and I'm going to escape the prison and all of that sort of a thing, you know? And so you're really putting a lot of expectation on yourself, right? Whereas I'm kind of sitting here like, well, like, I want to be the best at this that I can. But there's also kind of this acknowledgement that there's a really big limit on how good as a retail trader you can actually be. The amount of edge that you can catch on an intraday basis, right? So you have to temper your expectations. And when you have those tempered expectations and you're trading super, super small size, then it's, it's a different game, right? The other thing, though, is that, like, most people are trading a random line. Okay? So like, in my opinion, 80% of the quote-unquote psychology problems that retail traders have is because they don't really actually have an edge. They think that they have an edge, but the reality is that they're just taking on risk. They're making money from taking on risk, trading a random line. And trading a random line will turn anyone crazy. Will turn anyone crazy. I don't know. You know what? So here's the thing. Like, something that I'm thinking about. Like, if I can segue for a second, or take a little detour for a second. I really like to watch Devin Nash. He's just my kind of guy. Really into the business stuff. He's like the, neuro. I'm not going to say he's autistic or ADHD or anything like that, but he's kind of got like that neurodivergent level of interest in subjects, but his subject is business in general and running businesses, and especially like online businesses and marketing and YouTube popularity and stuff like that. So he had a video out yesterday about, like, the really big influencers. They kind of want you to hate them because they get so much views from the hate, and those views just cancel out. any kind of like, the few engaged people that really know what's going on and everything, and they hate you because of that. They pale in comparison to all of the unengaged people that are just coming in and saying something about the product or whatever the deal is, right? Okay, well, I'm never going to do anything that I think is going to be harmful to my audience. I'm not going to go and I'm not going to do things that I think are illegal. Like if I'm talking about trading and there's a possibility that you can make money, there has to be equal emphasis on the possibility that you can lose money, right? But at the same time, I feel like I've censored myself too much sometimes. Like that I've been too concerned about that YouTube will come along and do something and hurt the channel, which I kind of feel like maybe that's already happened anyways. Or that I'm just trying to temper, the rhetoric and whatever, because I don't want anybody to come in and get like too crazy of an idea about what's going on and whatnot, right? But on this one particular issue, I'm kind of starting to realize like, hey, when you talk about it with people, like people will come in, maybe you dissuaded them from picking up trading because they're not really prepared for it or whatever the deal is, but you don't see them again and it doesn't really do anything for us. And I kind of feel like, hey, maybe we should take this a different direction. The different direction is this, okay? It's a trap. They want you to come in and trade it when you have no clue what's going on, because whether they are the liquidity providers or the informed traders, there needs to be a certain amount of noise in the markets for the market to work. That means there has to be a mass of people out there trading that really don't have a clue what they're doing, right? So the whole idea that you're going to come in and trade and day trade and become a millionaire from day trading, like, yeah, it can happen. I'm not saying that like you shouldn't attempt it, but you should realize that it is a trap that's been set up for you. They've created this thing that's look appealing to you, so that the rich guys that are basically in charge of all of this have that noise to be able to trade into. They're taking advantage of you. So if you're going to actually day trade, you've got to understand that and not fall for the trap and not trade if you really don't know what's going on. You really don't have some sort of an edge, Now, okay, so Mr. Pushup asks, you don't believe there's any room for discretionary progression? Well, there is, but there's still like, how do you build edge? Okay, so like, here's the thing. When you talk about discretionary trading, like the thing that we can do that your robot can't do very well is intuition, right? We're starting to make intuitive systems with ChatGPT, right? But that's just like being able to speak. It doesn't use logic. It doesn't really understand what's going on, right? But it's using the same kinds of systems that we use to build our intuition, right? So if we're building intuition, the biggest problem, you think about it like you're training a ChatGPT or whatever the deal is. The biggest problem that we deal with in the machine learning world is bad data. Like one of the problems with ChatGPT and stuff like that is that they're training these machine learning algorithms on data on the internet. And then what's happening is people are taking these models and using that to generate content. And so then the next generation of robots, all of the data that they're getting is data that was generated by robots before now instead of humans. And then the effectiveness of those AIs is less because the quality of the data is declining over time, right? Garbage in, garbage out. So if you're building intuition, you need to build that intuition on things that you know are correct, that you know are true. That's why we focus so much on empirical information on this channel. When I make these like one-off videos and stuff, I'm trying to teach you about recent studies and stuff that we can use that I think can be relevant to retail traders to kind of
Block
build
sell.
that knowledge so that you can then come into the market, watch the markets every day, correctly interpret what's going on, and use that to build your intuition. So is there room for discretion in the trader's journey? Absolutely there is. And I do think that with the right amount of work and you know, you're going to have certain qualities and things like that, that you can come in and you can be successful trading, especially if you have enough capital. That's like the biggest thing that'll hold you back, is that you don't have enough capital to really take big enough swings, right? If you use all that information and really put your hand at it after 5 years, I really think that you can become at least break even, right? But even with that success, like that level of success that you can have, you just got to realize the amount of edge that's really available for you outside of just taking on risk itself is super, super small. It's super, super small. And this idea that you're going to come in and you're going to bust out of the jail by becoming a day trading millionaire, it's a fantasy. It's a fantasy that was created to make people that don't really know what's going on come in, try their hand at it, and just provide noise for the markets, right? We don't want to fall for that. We want to come in. We're not going to take a trade unless we really explicitly know that we have an edge. Like, I'm looking for a situation where there's something that I know about the data, about the way that these things tend to play out, and the markets overall, that I have a really strong idea of what the future orders are going to be. And if I don't have that, I don't take a trade. Now, there's the other side, which is the mechanical side. There's a lot of room for mechanical edge still, I think. In fact, I'm kind of wondering, because it kind of seems like momentum strategies aren't working as well. I haven't looked at mean revision. I haven't had any good sources on, like, you know, here are the funds that do momentum and here are the funds that do mean reversion, and how are mean reversions ones. I only see momentum. But I'm kind of wondering, with all of the funds out there that are doing momentum now, because there really is a lot of them now. Like, since 2020, like, the number of funds like that just skyrocketed, and that might be why it's not doing so well, right? And so that kind of makes me wonder if maybe there's more opportunity now for retail traders to do swing strategies that can produce. I don't know if those swing strategies would necessarily outperform the S&P 500, but again, you're, like I'm saying, you're not going to become a millionaire from this, right? So what are you really doing? Really what we want to do is or part of, I think that if you're going to trade, or especially day trade, that part of your motivation has to be that you just want to be involved. Honestly, you love markets. You think that markets are an important part of society, and you want to participate and be a part of that, even though you know that, like, the potential for large gain is pretty small. Yeah. So that's, like, my full opinion of it. And the thing that I always kind of held back is, like, it's a conspiracy theory, but I really do believe it. I really do believe that everything that the public is told about financial markets, it to some degree is crafted to trick people into providing noise for the markets. It is. Because none of the professionals would ever tell you to day trade. There's not I bet you there's hardly anybody. You go to talk to people that work at Goldman Sachs and JP Morgan and Citadel and all the hedge funds and about. You're not going to find very many people that will tell you should day trade. If you tell them I want to day trade, they'll probably talk you out of it. They'll probably try to talk you out of it. I'm saying, well, I think that there are other reasons to be involved in markets beyond just that you could make money from it. I think that what we do is important, and it is a necessary part of markets. And we need people that come in here and understand this and understand what's going on, because the robots don't understand what's going on. The firms, they often don't really care. They don't make money from knowing what's going to happen or from being informed. There needs to be somebody that makes money from being informed, or is at least trying to make money from being informed. That's where we come in. Let's see here. That was fast. Are you talking about Octavius's trade there? Well, give me a heads up next time and I'll buy some. I tell you what, man, you've been on a little bit of a roller coaster with your TLT the last week or so, haven't you? I mean, this move today is like, you're a sucker. Well, just because you come in and you think that you're going to become a millionaire from day trading does not make you a sucker. I think that most people have kind of fallen for this this narrative, because it was listen, man, I'm like almost 40 now, right? And now I think back on it and I'm kind of like, you know what? I feel like that I've been primed my whole life to some extent to want to come in and think that I can beat the market. Like from the 80s on, there's all of this stuff to, you know, glorifying day trading essentially. And like back in the 80s, like it was a different game. And then now in the 90s, it's like it's been all been taken over by robots. And like the entire world has completely changed, and the game is just not even close to the same game as it was in the 80s. And like all of our media and everything doesn't reflect that. It's kind of weird, you know? No. Now, if you are constantly buying trading combines or funded trader programs every month in the hopes of being able to pass a combine, and you've done it more than 3 times, okay, then you're a sucker. Okay, combines are for suckers. You go in just by random chance. There's a 30% chance or so, between 30 and 40% chance that you will pass the combine just from random chance. So if you're doing it over and over and over and over again, that means you really don't have an edge, and you're just wasting your time. And then the stupid thing is you get funded, and some of these guys, they don't even give you a live account. They say, well, if you are profitable, we'll pay out, and we have to approve your payout and everything, but you're not actually like live trading. Okay, that is not funded trading. That is a bucket shop. It should be illegal. This is the other thing that I feel like I hold my punches on a little bit too much. Like, I haven't made a video in a long time about combines. And maybe part of it is like, I don't really have any interest in like being a part of the combines, but I don't want to like piss them off. There is certainly something too that like, the combines seem to have promoted certain people, and you know, if I was still in the combines and everything, it would help the channel and everything. But now I think about it and I'm like, no, actually I don't care. I want to say what needs to be said. Most of the time, it's not a scam. I mean, they're providing a service that's and they're being truthful about the service, but a lot of the time they're suckering you. Yeah, and they're suckering you. What would be a better word for that? What should we call, what is the derisive term that we should use for combines? They're not a scam, but you are a sucker if you're doing it over and over again. I think to be successful at trading, you need to incorporate hedging, like ES is up, bonds down, etc. I mean, I might be wrong on the underlying, but correct on the other. Well, yes and no. I mean, so the issue when you come into things like hedging, right, is like, just as an example, let's say that we're going to trade spreads. I think that this would be a good segue into talking about spreads. Okay, so I can come in here and I can say, well, it does look like we've flattened a lot, right? So I can sell the 5-year and I can buy the 10 and the 30. That's flattening, right? And generally, overall speaking, if it continues to flatten, I should make money. But in a situation like that, it might only flatten for the rest of the period by a few ticks, right? And you have to, especially with the way that I would be trading it, where you're legging in on each side, that's a lot of commissions that you're paying, because you're basically you're paying double the commissions for profits that are like half as much, right? So in that kind of a situation, the prices that you get matter a lot at that point. And getting 1 or 2 ticks slightly better execution is kind of, or slightly better, positioning on one side of the leg or whatever can matter a lot to your end payout, right? So this kind of comes back to like the same thing with options. So it's like, if you're going to do options, you kind of have to have a really good way of saying what should the option actually be worth. And I kind of feel like that for spreads, that there might be a similar sort of a thing going on, Apparently there was an audio leak. Where are you reading that? You know what? I don't have my Twitter up for some reason. What's with that? Oh, you know why? It's because I got the wrong. Throughout the day, I'll open up extra windows and then start using the wrong window. Essentially, that's what I did. Let's use this one. Keith McCullough of Hedge Eye tweeted it. There was a leak of the jobs report. 3 minutes. Well, I don't know. That's kind of curious, because there wasn't really a whole lot of market movement at that time. Whatever. It's a scheme. Trading combines are a scheme, maybe. I don't know, especially these ones where they don't really give you a live account. I feel like the Top Step. So this is a really weird thing about the way that the combines work, right? Because it started out like Top Step was the only one, right? And Top Step figured out very early that, like, hey, you can just kind of get lucky. And if we give everybody that passes the combine immediately an account, there's kind of a problem. And so that's why Top Step actually has a 2-step process. Like, they don't really say it on like all of their front pages and everything, but when you start diving into the documentation and everything, you find out, okay, there is an interim time period where they don't give you a live account yet. Okay. So then there were other trading programs that trying to copy what they're doing. And so how do they compete with them? And one of the things that they'll say is, oh, well, we'll give you an account right away. You don't have to pass the combine twice. You just have to pass it once, and then you're funded. And they're running into that problem now. So there's like, oh, actually, well, we can't put them on the live account. It's just, it's so dumb. Like that should be the big warning to you that, like, people don't really actually make money from this. Like, there's going to be one guy that made like hundreds of thousands or maybe almost $1 million doing it. But most people are not. And like the thing that's the wildest to me is how many people I'm seeing that are saying that they're like doing copy trading. That they'll buy multiple combines and have all of the accounts like triple traded or something like that. You buy 3 combines, but they're all taking the same trades. because apparently like you make more if you just buy a bunch of small ones rather than doing the big combine or something like that. It's just like, you're just giving them more money, man. That's me. Talk to me. I copy trade. Why are you doing it, man? Why do you copy trade? I don't get it. But like, are you actually getting paid out from it? Because it kind of seems to me that it's just like a way to give them more money. I make more money. So you do make more money than if you like bought the large combine, right? I honestly wonder if some of these combines aren't kind of pulling kind of social media deviousness to encourage people to do that. You know what I mean? Like especially since for these, at least for earn to trade or whatever it is, or is it Apex? Maybe it's Apex. At least for Apex, it's like you're not supposed to. They won't pay you out for doing that. But I kind of wonder if they're not like, oh, on one side, we'll go on Reddit and whatnot and comment like this and encourage people to do this, even though it's against the rules, because then we make more money from their doing more combines, but then we don't actually have to pay them out if they actually make money. You know, like. Oh, hold on. I think I see what you're saying. Let me see if I get this right. Well, let's look at Top Step. No. We'll do Apex too. Apex. Apex funding. Because Apex is the one that everybody keeps complaining about, right? Okay, so they have a 50K, and they have a 100K, and they have a 150K. So if you were doing three, your profit goal is 1,500. Oh, no, wait. There's 25 and 50. Let's do the 50. So the profit goal is 3,000. So does that mean that the 150K is 9,000? It is 9,000. So I was thinking, oh, okay, the profit goal is closer, but it's not. It scales correctly. What about how much it is per month? You do the 50K, this is 167 a month. And if you do the 150K, it's 279. Oh. $1.86. Oh, 167. 279 divided by 167. 1.67. No, it's, you make more if you just you spend less money than if you just do a 150K account. What about number of contracts? You can trade 10 contract. Oh, you can trade 10 contracts over here. You can trade 17 over here. But if you do 3 combines, then you can do 30. So you get almost double the leverage if you do multiple accounts. Aha. I think what makes trading hard is that you don't know if the sellers or buyers' market orders are entering or exiting the market. Yeah, well, I'm not going to say that that's what makes trading hard, but like the thing that most people are trying to do, which is like trade based purely off of what other people are doing. And I think for that to really work, you would have to know whether they were entering or exiting. Yes. Because if you knew that they were entering, then you could say, hey, there's this guy, they're short like this much. And they're not making any money off of it, and they're losing money right now. And how far is it going to go before they're going to puke, right? Yeah. Once you start getting into, are they entries or exits, you can start to do these gaming out of people's positions and playing that game. And there's no way that they would ever allow that. Like, straight up, this is something that I came up with this idea on my own, that this is what's going on. I've never ever heard anybody else saying this, so I find that a little suspicious. But it seems to me that a large part of the drive behind the institutions in particular wanting to move the markets from an open outcry system to fully electronic markets is because when it was in an open outcry position, the floor traders could sniff out what they were doing, and you can't do that in the electronic market. And I think that that was a major factor, because to me, that's like one of the biggest differences between an open outcry and a fully electronic market. And there's a lot of things about open outcry markets that seem to be beneficial, because you have everybody there in the same place, and they can like share information, and they can have like business relationships and things like that. Like if you're trading with a market maker that's like a good market maker that's known and has been around for a while and everything, and then you screw them over every time, you know, they're not going to want to trade against you. They're going to, you know, they see you and they're not going to, yeah, I'll cross with you. No, they're not going to do that. They're going to say, no, you screwed me last time. F you, right? In the electronic market, you can't do that. It's completely anonymous, right? I seems like, so you're right. There are some markets, by the way, that kind of provide, like in China, that provide, what do we call it? Basically information about open positions every 5 minutes. Open interest, there you go. Like 5-minute open interest data. Let's hear. No, I say you get paid faster with the smaller ones, and then copying them, you can make up for the fact that you don't have a big account. So in 10 days with 4 small accounts, I can make 8K instead of 2K with 1 big account. Might be different on different ones, right? Which funded trader program do you use, Mr. Push? Those X870 motherboards are nice. Oh, yes. Wait, why are you talking about motherboards? By the way, Linus Tech Tips, he had this video the other day where they bought a bunch of broken motherboards and fixed them. And they made like $2,000 fixing motherboards. like I started doing the math and everything, and they were making like $200 an hour fixing motherboards. I don't know if it would really work that well at scale, but I was kind of sitting there because I'm between jobs right now, and I'm like, hey, maybe I should do that. I don't think that would be a job that I would. I'm not super great at tedious things. I'm not super into. I get bored of it, you know. I think the worst thing that I ever had to do for my day job was we had made a change to the one of the risk systems that kind of says, okay, like how much of their credit limit are they using up, and can they still trade, sort of a thing. And you know, so we made this new system, and you have to prove that it works correctly, so you have to make tests, and the way that the tests worked in that system was a spreadsheet. So you basically had to make this a spreadsheet where you say, okay, this row, this column, this is what the value is supposed to be, and do that over hundreds of these values in this spreadsheet. And it was tedious checking, right? Manual checking. Absolutely. It was an absolute nightmare. It was so tedious, and I'm like, this is like the worst job that you could possibly give me. You know, like, why aren't you giving me things that like I excel at? And they're like, well, but you should be able to do everything. And I'm like, no, like part of your job is to find what people are good at and get the most out of them, not just pass things to people like you feel like it. Like, what the hell, dude? I kind of felt like that I was being set up to fail at. That was when I started to be like, I think somebody don't like me and they're setting me up to fail, even if it's not completely consciously. But my wife, she likes tedious things. Like she does those what do they call them, like jewel painting sort of a thing. So it's like they send you this picture. It's like a big mat, and the mat has a little tiny grid drawn on it with numbers inside of the grid, and there's a picture, and then there's these little jewels, and you push you take the tape off because it's sticky. Take the tape off, and then you stick the jewels to the thing, and you make this painting pixel by pixel at a time, right? She loves doing that. I'm like, it's just a tedious, repetitive action. Why do you like it? She also likes painting. I keep showing her Warhammer stuff just because it's like the painting that they do is crazy, and she likes to paint ceramic stuff. So I'm like, you could get into fixing motherboards, because basically what it was is like they had like this microscope, and they were like bending the pins back because somebody like bent the pins on the motherboard. $200 a day, like that's a good gig, man. So if you haven't seen that video on Linus Tech Tips, go watch that. It was kind of fun. Of course, now that they've put that out, probably everybody's buying up all the motherboards now, right? Okay, you are doing Apex. Now, so then see, it seems to me that what you're really taking advantage of is the leverage. The smaller accounts have more leverage. Yeah, okay. It's kind of weird that the larger accounts don't give you, 3 times the number of contracts. What's with that? That's kind of, I almost want to say suspicious. Oh yes, we'll let you pay more money, and we'll give you less leverage so that it takes you longer to pass the combine. Okay. It's funny. So you know what? Here's the thing. Okay, so yesterday we took a trade. I was short, and a headline came through the market about tensions in the Middle East, and the market kind of started going against my position, but I held out and was able to make some profits on the short side. And then like eventually I got out at like almost a perfect time. It rose up a little bit after I left, and then it came back to where it was by the end of the day. So it was an okay trade, and it was like an example of me taking on risk and all that sort of a thing. And so then I started to think, well, like I dislike the combines, but like maybe one of the ways to like make the best content to say like, you know what, like combines really aren't worth it, would be to show them like, hey, I can just pass it, right? Like here's what you do that passes it, and it's not a good long-term strategy, and here's the problems with it. Okay, so then I started looking at like, what have I been doing? Well, I did that trade yesterday that worked out. Like, how often can I do that and get away with it, right? So I started doing the math and everything. But I was trading too big. Like, I think that if I was doing that, I probably wouldn't want to get more than 3 contracts in the treasuries, because you don't want to come anywhere close to that $500 daily limit, right? I was also kind of thinking about it yesterday, because part of the reason I was going into it was like, okay, if I am using multiple orders, and like, is it okay for me to just take a 1 tick profit here? It turns out, if I'm using an extra contract that doesn't matter and I just want to trade the 1 tick back and forth, then like it's okay. But with the risk parameters and the risk reward that I want to take and everything else like that, it seems like I have to go for more than that. That I have to go for at least 3 on my shortest trade. So, but I started to sell myself on the delusion. I was like, well, I could just, take on risk and do that for a little while, because I do think that with a little bit of luck, I could come in and do stupid things and pass a combine. Yeah, maybe not. Not today. I really don't know if there's a good trade for us today. The way that this bounced is really interesting. It's just like this slow curve, right? Took a really long time. It's been an hour. Look at the average position though coming down to us now. So now this is in a reasonable place. Maybe. Oh, I don't know if we're gonna get a pullback all the way up to there though. Oh, Joe Biden's speaking. He's talking about the jobs numbers, and they care about the jobs numbers. Yes, they do. I might have to. I was looking at Top Step Trader. Anyways, I don't know. What do you guys think? So let's do a little poll here. Do a little discussion. That's my notes on my job search, and that's on my notes of making sense of chaos. But what I want to do is there we go. Did that one. And videos. It's funny, I have to What was I doing with? What was I thinking with the biggest things holding traders back? Let's use this one. Still don't know what I was thinking with this one. Must be this one. Yeah, it is this. Biggest trader mistakes. Let's call it that. I still want to make like a macro video, but that one's hard. Oh man, we're down to the lows now all of a sudden. I didn't even realize. Because remember I said like it's really hard for them to really extend and make new lows after a big move like that. But they're going for it. Some big icebergs there. There's a big order at 29.5. So you might be able to run with that a little bit. If it's going to go, you're probably not going to get filled on the offer, huh? Yeah, you sold L3. Oh, that's not bad. Well, I already don't like the way that that's going. Like if they're like breaking there, it should just be going, right? Yeah. I mean, the thing is, this is definitely like a day that could trend. I don't know if we're going to go like really can go much further than we've already been, but like there's nothing to stop us. It's just the orders at this point. As many orders as they have to sell, and there might be a lot. Man, like the cumulative delta on the initial news was like the change in cumulative delta was basically 45,000 contracts. 45,000 net contracts sold on the news. That's bonkers. That's bonkers. Or no, I just didn't like that. It broke. I got filled on the offer, and then it was bid again and big stack. And I was like, no, they should be continuing to push into it if this is like some sort of a stop out sort of thing. I got my 10 points, but I still feel like an inadequate degenerate, though. Huh. I don't know. Like, what did you do? You came into the S&P 500, and you bought the S&P 500? Because I mean, like the edge today is that number was a really big deal. They're gonna sell treasuries all day, right? It's just a question of like, which spot do you pick? I don't really have anything to tell me what's a really good spot within this to try and take a piece of it. I like to take trades as they're coming through those key areas, but that one did not take at all. So I'm glad that I scratched it. It kind of makes me want to try the hero trade now, to be honest with you. Like Octavia says, plenty of ammo, stuck sellers for the hero trade. Yeah. Like if it doesn't go and they come back up to like the 1304 area, it wouldn't surprise me to see it come back even more. Or like maybe we just have a VWAP bounce sort of a situation. I don't know. Anyways, so the question was, what video should we make next? So let's put it up to a vote. I'll pick 4. Start a poll. Okay, there we go. Got a poll up. Picked 4 of those options. You tell me which one is most interesting to you. They put in a bid at 29.5 because of the big order. See, when it was breaking, I was kind of thinking like, well, okay, it looks like they're breaking a new low. They have a little bit of velocity with it. So I tried after she goes, and it, that was one that should have just like immediately gone. And there was that big order down there. So it's like, maybe they're going to go for it. And they didn't immediately go for it. So I gave up on it and just kind of happened to be right on that it was a good idea to scratch it, I guess. There has been a strategy that non-farms payroll retraces more often than not. Oh, I bet you probably, yeah. Like, I don't know about retraces all the way, but non-farms payroll has this strange tendency to not do what it's supposed to. It's like the number comes out and there's like this initial kind of gut check reaction to it, and then you decide whether it's that you decide that it's going to go further or that it's going to pull back. The market starts doing something that makes absolutely no sense within the context of what the news was. So my kind of theory had been that the flows that you get on Fridays from people closing positions and everything for the weekend and oftentimes end up mattering more than the non-farms payroll. So not in a situation like this, because this one's a big shift, but like if the non-farms payroll had come in like in line, like let's say that it came out what I thought was going to be 175,000, and the S&P 500 it rallies and the treasuries they sell off, just not as extreme as it has been here today, and then you go and you take the trade like, maybe this is a big deal, I should sell the treasuries because of it, right? And then it will like just magically float up, and the price action makes absolutely no sense as to why it would be doing that based on the news that we just had. Because, well, people closing their positions for the weekend is a larger flow than the people trying to trade that, small beat in non-farms payroll. Something like that. That's kind of been my thought. So in non-farms payroll, it does weird stuff, especially the last, like, since the pandemic. Since the pandemic, it's been particularly like, what? That's not why I pressed the trade. I just saw it going down and discretion kicked in, I guess. I don't, maybe risk taking. I think like one of the big problems that you have, again, like when you're building your intuition, something that matters to building intuition is like the order of things, because there are certain things that can happen to you that end up being such a big signal to that network that the network has a hard time seeing anything else. And so if you introduce that thing at the very beginning, it makes it hard for you to learn other smaller things. So like the example of this in humans would be interest in the other sex, right? If you're a kid and you become sexually active too early, then that's all you want to do. And, a lot of those kids ignore school and all of these sorts of things and end up getting themselves into trouble. And so our society has learned and has kind of decided, like, we don't introduce them to each other until they're a little bit older and more mature. Because if you teach little kids about sex, it causes problems. It causes like actual developmental disorders and stuff like that, right? It's because it messes the brain network up if you introduce it too early. So it's the same thing in trading, and the one that will really screw you up there is if you really swing it out of the park. Like you catch a trade that just runs and runs and runs and runs, or you catch like a really big reversal, and now you're always keeping an eye out for that. Why should I put my own money up front and said I can wait for a promo and only put $30? Well, I guess if they have a promo when it's $30. But like honestly, if you like again, there's a 30% chance that you will pass the combine randomly. Okay. Also, pretty good chance that it's going to take you more than 1 month to pass. Okay. So let's just say that you take the combine, you do $150 per combine, and it takes you 3 tries to pass it, and it takes you 2 months each time. So that's 150 times 6, that's 300 times 3, that's $900. $900, you could have put that into an account and you could be trading micros. And you know what? In both of those situations, because if you make a small account with micro treasury yield futures, right, and you're trading that, I mean, that's not going to make you any more profitable, right? But if you take that $900 account and you start trading it, that can last you 1 or 2 years of trading before you're going to have to put more money into it. And by that point, you've probably, if you keep saving up the money that you would have spent on the combines every month, you're going to have an even larger account. So I really don't think it's worth it. I think that you get more trading out of a small account. The other thing that I don't understand is like, okay, so let's say that you do the combine thing and you actually make money from it. Okay. Why would anybody like make $10,000 from doing that and then keep doing their thing? Like at that point, if you're really that profitable, take that $10,000, put it into your own account. You'll get more leverage on your own account. You can do whatever you want and you'll keep making money, right? The only reason that you would continue to trade the combine indefinitely is if you know that there's not really an edge to the thing and you're really trying to force them to take the whole risk. Because eventually there is a point where your account is going to get larger than what you're going to be able to do on the combine. It's not like seriously, if you make $10,000 on the combine, right? You put a $10,000 account in, you can have a drawdown of $10,000, right? Like if I'm trading the treasury futures here, okay, I could trade 20 contracts with that. Yeah, in a real account, what you would draw, that's true. Well, yeah, there I see all this thing about people, using the leverage by having multiple accounts because they scale down the leverage on the larger accounts. That's the thing for sure. But again, like if you're really profitable, I say so. Like you trade the combine and you make $10,000 off of it. Why wouldn't you then just start trading your own account at that point? Now you have a large enough thing that it's to have like a really large account and do stuff with it. And now you can hold positions overnight. You can break their combine rules if you really need to. Like is just like so much more flexibility and the profit potential is so much higher. Because you're not doing a split with them, you're not sharing it. There's a point, there's going to be a point where it statistically makes more sense to trade your own account, right? You can get better fills trading their sims than, oh, well, that's true. That's true. Can I express this with math? I'm not quite sure how I would. So let's say they give you 3,000 to work with, basically. Like, they say it's a $50,000 account, but it's basically the drawdown is 3,000, right? So that's really what you're getting. It's 3,000. And you can trade 5 contracts, right? Okay. Versus X. X divided by 500 is the number of contracts that you get to trade. So, like, what is the account size at which you are making more from over here? Well, so if you want to trade 5 contracts, that's 2,500. Right? Okay. So basically, if you took $3,000 and put it into your own account, you would get more leverage than you get from the combine relative to the drawdown, right? Because in that account, you can draw down all the way down to, actually, it would be about 3,000. 2,500, but then you have to add the amount onto it, so it's 3,000. Yep. So they actually have thought of that and tried to make it equal. Except for, so then the difference is that on this one, you have to do the split, right? And what's the split? So 100% of the first 25,000 and 90% after that. It's not a career. It's for suckers. Maybe that is the video that we need to make. Let me go back, okay? Here's the real problem. Who is this guy that is consistently making that amount of money, you know, $3,000 a month off of you know, a teeny account? You're basically okay, so like your drawdown, let's say your drawdown is 3,000, your profit is 3,000 to make the math easier, right? Who is this person that can double their account every month and doesn't already have their own really big account? Where did you learn to do that without your big account? No. The whole point of the combine is to get a ton of suckers that think that they're going to pass it to go and try it. And the whole thing is that the way that it's set up, about a third of them should just pass it randomly. Of course, the amount that actually do pass it is less than that because people are stupid. Okay, but just if your trades were perfectly random, you should be able to pass 30% of the time. You can go and do a Monte Carlo simulation. You'll pass 30% of the time. So you get all these people that say that they're passing, going and promoting it all. This is the greatest thing ever. Some people that even get some payouts. But the reality of it is that the way that they make money is from all of these people trying to come into the markets and thinking that they can pass a combine when they really can't. And the way that you know that that's the way that the business really works is that when you pass a combine, they don't give you a live account right away. Right? So all of the assumptions that you're making in there are, I'm a profitable trader. No, you're not. You're just lucky, and you're probably delusional in all likelihood, right? And so if you come in with the assumption that you are not a profitable trader, then what is actually the most sensible thing to do? I'll tell you, the most sensible thing to do is to get the most trading out of the money that you have, which means fund $1,000 account and just trade sim, or if you really want it to be live, trade micros, trade the smallest size that you can, and you will get more trading out of that money than you will if you did the combines, right? The combines made sense when there were only ES contracts and there weren't any micros or anything like that. And so in order to really practically trade index futures, you needed to have like $5,000 to $10,000, right?
Block
and
buy.
Most people in America don't have $10,000 laying around that they can just straight up risk, right? Then the combine made sense because, you know, that they were giving you an opportunity to take on risk that you couldn't on your own. But with the way that it is now that you have micro contracts, you get more trading off of funding your own account. As of 2 weeks ago, most firms have banned trading treasuries. Well, I don't know about most firms, but I heard that Apex did, yes. Because the fills were so inaccurate that people were taking advantage of it. Yes. But I'm saying, take the $1,000, like seriously, how much money are you guys wasting on combines? Right? Like, because you're talking like you're doing 3 accounts and all of this, that's like thousands of dollars. You do that 3 accounts and then you don't pass that time around, and then you're doing it again. Like, oh my gosh, that's already like $900, right? And it's just going down the drain. And then you do that multiple times when you could have traded for less. If the whole thing is, I just want to trade, even though I know that I might not always make money from it, you'll get more trading for less. Like, it's just so much money. Or like the big one is, like, I see some people that have been doing this for years. Like, they've been going through combines, they'll get funded for a little while and then they'll lose the thing. And, like, you know, how much money have they dumped into it after you've been doing it for years? Then maybe you could have afforded like the $10,000 or $20,000 account, where then you could swing trade, and there are some edges in the swings that I can like straight up show you that will make you money in futures. When you can hold overnight. It's just, no, they're for suckers. See, let me tell you what, man. You guys are trying to convince me that like it's a better deal. Just makes me more determined to make that video now. Because the whole thing is it's like making the controversy that generates the interaction, right? I missed the hero trade to the VWAP. It was pretty brutal, wasn't it, Octavius? You know what I find so curious about that one, though, was that it was exactly when I was like, oh, are they going to go for it? And then, okay, they're not. And then what did they do? Back to VWAP. Wow. I should have at that spot just gone for the reversal, huh? Do you ever trade real money in the combines? What does funded mean? If not, the only way that you get paid is out of the company's income from combine subscriptions. Exactly, Greg. There's this whole thing where it's like you pass the combine and then you trade their demo account after that. And if you've traded it for long enough and you're consistent and whatever, then they might give you a live account. But hardly anybody ever gets that far. And then you're right. How are you getting paid? You're getting paid out of the company's income from combine subscriptions. You know what that's called? A bucket shop. It should be illegal. If you pass it should be set up that you pass the combine and then you're live trading. And you are not eligible for payouts until you are live trading. Otherwise, it's a bucket shop. We like bucket shops then, yeah. Well, guess what? A lot of people liked bucket shops back in the day, and there was a reason why the government in the United States banned them. The same thing with, there's a reason why in the United States that contracts for difference or whatever are not contracts for difference. What are they called? Is that what they're called? Anyways, you know, they have these in the UK, but they don't have them in the United States, and there's a good reason. And I can't believe that in Europe and the UK that they still allow those. Go ask them to ban them. That is exactly what I am doing right now. Is I'm asking them to ban bucket shops, right? Well, I'm not asking them to ban them. I'm asking them to enforce the existing laws. Yes. No, don't, Paul. Don't discourage him. This is what we want, right? We want. play into it. We can play into it. I'm good with that. Because bucket shops work just like regular trading zero. Well, the reason that the bucket shop is a problem is because the bucket shop makes money when you lose, essentially. And so the whole thing is basically rigged against you to lose. And it's frankly, with the combines, it's the same thing. The profit targets and everything that you're being given are essentially designed to be so aggressive that the chances of you just randomly blowing the account at some point are extremely high. Like again, they say it's a $50,000 account, but you can only lose $2,500 or $2,000 or $3,000 or whatever. It kind of changes between combines. I like to say 3,000 target, 3,000 stop, because it just makes, if you want to do statistics and everything, that's a little bit easier on you, right? Okay. So if it's a drawdown of 3,000 and a profit of 3,000, then you're basically asking somebody to double their account in 1 or 2 months. Okay. With that amount of leverage, the chances of you blowing it at some point are extremely high in futures. Extremely high. And so that's the whole game, right? If they turned it into, if it was like, okay, we're going to give you a $50,000 account, like a real $50,000 account, right? Where you can literally trade, if you're trading treasury futures, right? It's $50,000 and you get, every $1,000 is 2 contracts, right? Then that means that you can trade like 500 contracts or something like that, right? So now you can do things like market making strategies. You can do things like swing trading strategies, okay? And if they said that, and then they said, we're going to benchmark you against the S&P 500, right? Okay. So now you're trying to maybe make 7% per year. And it's really more like, how consistent is it? That you get that 7% every year, even if the S&P 500 is down, right? Completely different game. There are all sorts of professional strategies out there that are known and documented, like momentum strategies that do that kind of stuff. Momentum's not going so well right now, but it's still a thing. That's like the turtle traders. That's what they were doing. So I saw that I had this thing, was arguing with somebody on Reddit, and they brought that up. They're like, well, yeah, but except for that, we know that, like, the turtle traders prove that the psychology is a thing. And it's like, they were swing trading, guys. They were swing trading. Like, In a game as competitive as this, there's really no point in trying to make your competition better at it. Yeah. Right. So this is the other. See, as I'm arguing with you, I'm kind of sorting out like what are my best arguments here to actually use, and probably the argument that I should be using is this: that the combine pushes you too aggressively. Fund your own account, trade smaller. Don't go for you're trying to double your account every month. Go for, hey, if I can trade all year and actually come out with a profit, you're in a pretty good spot. And if you can come out with a 10% profit over the year, then you're beating the market. That's like, if you can do that consistently 5 years in a row, we can find you some people that will give you millions of dollars, and then you can make money just on the managing the money, not even off on the profits. And then the profits is just the extra, little treat on top. And that's where you can become a billionaire, right? And instead, we've got everybody trading on these combines that are basically, they're destined to fail. They're basically destined to fail. Yeah. It's just a card game between devils, greedy traders, and greedy props. Yeah. They're explaining how everyone has always interacted with capital markets, or they've always gamed the system. Yeah. So I'm really interested here, on this poll, because we've had 13 votes. We got 18 people here, so most of you that are here have voted. And it's 77% for order flow misconceptions, which I should have guessed, really, right? You guys that are here with me every day, you're here for like real knowledge, and that would be the thing that would be like the best piece of order flow knowledge that we could give people that's not already on the channel. So we should make that video. I think it's pretty much settled. I'm a little disappointed that Combines for Traders wasn't closer, because I really want to make that video now. Combines are for suckers. Where can someone read about or find out about market making strategies? They don't have the money, of course, but I want to know about it. I guess it kind of depends on what level you want to know about it. So my favorite book, I actually have it over there. I don't have it on the desk like I usually do, but Trades, Quotes, and Prices, Financial Markets Under the Microscope by Jean-Philippe Bouchot et al. A lot of the book is basically why does market making work? Like, there was this whole thing about like, well, we know that there are people that make money market making, and there has to be a way to make money market making or people wouldn't do it. But from a mathematical perspective, we don't completely understand why it works. And so there's several points at the book where they kind of progress through. It's like, well, there's this, but then there's this problem. Now we got this, and there's this problem. And it's not until the very end of the book that they really like conclusively show like, this is how market making is profitable. So if you really want to get into like the technical details of it and how like you approach this as like programming a robot sort of a thing, I would probably go and read that book, right? If you are trying to do it as a retail trader and you really think that market making as a discretionary trader is something that you want to do, or you have a market that you think is not very efficient where you think you could make some money doing the market making because there's not competition, then I would probably go and watch Gary Norton. And he has a course is very, very expensive. I know you have to have the money to do that, right? Or you can just kind of try and figure it out yourself, right? Put contracts at every price, and you take fills both ways and manage it. And you manage your inventory and everything, and just learn it yourself. You can't seriously want to live in prop land forever. Yeah. I really, so like when I talk about the people that it's like, why wouldn't you just fund your own account? I'm talking about these people that are like going on podcasts and saying that they made like $1 million from prop firms, right? And you ask them, why don't you do a live account? And the answer is basically, if I was doing a live account, I would have blown the account and lost all of it by now, right? Part of the whole thing is they eventually will blow out and lose the account. And when they do, it's not really any money off of their back. They don't lose anything. Whereas if it was a live account, you know, they would lose the money from their live account. And then they would have to completely start all over. And so the strategies that they're doing aren't profitable. They're just kind of taking advantage of kind of a peculiarity of the combines themselves rather than the market. Then why don't you do it? Because I don't want to promote to people that they should go and trade these combines, because then I'm just encouraging people to be suckers. Kind of like it defeats the whole point. Like, especially with these ones where it's like, you don't even get a live account. Because, like, again, I think that a large part of the, why you do this is just to be involved. So if your orders aren't even going out to the market, you're not actually involved. So what's the point then? And, like, it's not like I'm going to make more money than my day job. Okay, like, to make more money than my day job, you have to have a huge account. That's one of the things that I think is kind of crazy, is that even these guys that are, like, really making big amounts of money from these combines don't make as much per year as I do from my day job. So... Oh, why don't you trade your own account with actual MES? Well, that's a different thing, because I don't think that we really have a very good edge in index futures. Most of what happens in index futures is just random. So I avoid them. I haven't had a whole lot of success with them. I've done a lot better with the micro treasury notes. When I know what's going on in the market and there's a good trend going on there and all of that sort of stuff, I do pretty okay and I'm happy with it. And that's where, there's some edge. And the amount of edge that we have is very dependent on the market conditions, because I'm only trading one asset, right? Because I'm only trading treasuries. Then it means I have to understand what's going on in the treasury market, and the treasury market has to be going in one direction, right? Like if we were trading and it was like 2012, for instance, we'd probably be doing amazing, because that was a market where the treasuries were just always buying up and there was large amount of volatility in them, and there was good ways to make money from trade. And I know some people, or I knew some people that traded the treasuries during those times and did really, really well. The money was coming into that market, right? So how much have you? Well, it's only 3 days into this month, so I don't even know if I haven't taken any trades this month. Last month, I think I made $20. Right? Forget. I don't know, man. The fact that if I can make a video and people comment on that video as much as you've commented in the live stream today, then it will absolutely help my channel. And I have some interesting things to show people about the combines. Like again, I don't think people realize if you just come in and you take one trade a day, so you only take one trade a day, you have a set risk reward profile. You can choose what you want it to be. Okay, if you want to take double risk, or you want your winners to be larger than your loser, whatever you like, our thing can set that up. Doesn't make a difference, by the way. Okay, but you just come in and you take one trade a day, so that you're never going to bust the the maximum daily loss rule, right? So the only thing that's ever going to break you is the drawdown. Then you, and all of your trades are random, 30% chance of passing. Like straight up, 30% chance of passing. So there's all these people out there, they're thinking like, well, like it can be done. People can develop an edge. We know so because there are people that pass combines. Well, no, because there's 1 in 3 chance that you'll pass the combine just from pure dumb luck. Which again is kind of like, that's another thing, is like, okay, how many times did you take the combine and not pass it? Doing worse than random. So like, but that's the whole thing. Is like, if it's just random, why is it that like 10% of people pass rather than 30% of people pass? Well, because they're giving you so much leverage. You're just extremely likely to screw it up at some point. Like the chances of you being in a position and the market moving against you and you catch a little bit of slippage or whatever and you go over the $500 limit for the day is really high. The combine is designed to make you lose, because if they did a combine that would actually do like a reasonable strategy where you're looking to make like 20% per year rather than like double your account every month, the business probably wouldn't work. Business probably wouldn't work. You wouldn't get enough people willing to, you know, trade the small enough amount and be consistent enough over a long enough period of time to prove that they're actually profitable, right? You'd get these people that you'd have to be like, okay, you trade for 6 months and we can see your stats, and then you fund them, and then the amount of money that they would make wouldn't really pay for the business, and you wouldn't get enough people, you know, doing the combine all over again for you to make money. So in order for the business to work, you have to set it up where the targets are really aggressive so that the majority of people that take the combine fail it. Don't use props, you get played recording that. There you go. I think it would be tough to make a video like that that's exactly what I'm going for. But we'll make the order flow misconceptions video first. I'm still thinking about the chair thing. Do I want to make a video about the chair or not? Because the script that I recorded, I just was not feeling it. Maybe part of it was it had been a long time since I had recorded, but I just was not feeling it. I'll tell you one thing though. That was the one that I've done with the lens, with the different lens. And, oh, it looks great. It looks great. You can actually see the color in my eyes and everything with this lens. Yeah, I mean, they're just gray these days, but still, I feel like it adds a lot of life to the video and everything. That's the one where we're going to talk about index funds. Index funds. So that one is kind of a little bit on the like controversial side as well, I guess, because kind of what I'm saying in that one is like, well, you make more money, like it's a better risk-adjusted return, the index fund, but you're taking average people out of having any kind of say in the way that companies are run now. So it's like larger picture, it's detrimental to our society. It's centralized power more. It's creating more what would we say, income inequality and so forth. Yeah, but we'll make the order flow misconceptions video. Because I think that part of that is like, oh, well, what will that be about? But then I think that some other ones do know what that's about and like that one. So this one right here. So some misconceptions. You want to hear just like the brief overview of what I'm talking about in there? Okay, flows and equity indexes are different. So a lot of people are trying to apply order flow to equity indexes, but the reality is that a lot of the behaviors that you see in equity indexes are unique to equity indexes and are just random by the nature of it being a collection of 500 different stocks. So equity indexes aren't the best place to learn order flow, essentially. And you have a lot of the people that are like educators and stuff out there. They're trading index futures, so you're not going to learn much from them. Like what you should do is you should learn it on the treasuries, and then you can try to apply it over in the treasuries, because you're going to see the same behaviors, but things are going to happen faster over here. They're going to happen over a wider variety of prices, and there's going to be more noise that you're going to filter out to be able to see those things. That's why you want to do it over here first. And on top of that, like if you build a knack for it over here, you're going to have to completely retrain your brain over to do it over here, because the order flow is so different. Okay. The next one was about orders pulling. So some people say because the orders pull, that means that like the depth of market is useless. But that's not correct. What you're looking for is, okay, how many orders are there? How many pull when it becomes the best bid offer? How many pull when some volume goes through? And how many pull when or how many actually end up trading? And then if we move away from that, how many stack behind it? Those are all kinds of little spots that you're looking for along the way that tell you something about the state of the market and the state of the market makers and their inventory and all of that. And that's also why I'm not really a huge fan of the Vista charts, because the Vista charts don't show you that very well. You really want to look at the numbers on the DOM. Okay. The next thing is there's the arbitrage. A lot of, the movement that you see is because robots are arbitraging against a correlated instrument. And so you'll see it tick up or down, and doesn't really take a whole lot of contracts to make it tick up or down. Well, that's because the correlated instrument is moving and the robots are just repositioning themselves. So it moved because the limit orders changed themselves rather than people crossing over and making trades. Right? And then the last one is dark pools. Some people will say, well, because there's dark pools, why should you watch order flow? This kind of comes to this idea that people think that they're going to watch the data of what other people are doing and be able to make their decisions off of that. And if I'm not getting all of the data about all of the decisions that those people are making, then how am I going to make any kind of prediction, right? Well, but that's not what we're doing. We're trying to predict the orders, and not necessarily based off of like what other people are doing. In many cases, like the best situations are going to be somebody else is doing this and it's a stupid thing, and I'm going to trade against them. And so dark pools, it doesn't really matter. And more broadly, the volume that goes through the dark pools does eventually come into the market, because what a dark pool really is about is I'm a big institution and I need to sell several thousands of this thing, right? Well, if I go and I execute that at the market, I'm going to move the market a ton, and I'm not very good at executing that. So I want to have somebody else do it for me. I want to have Goldman Sachs or JP Morgan's block trading desk do it for me. But that means that I have to go and call Goldman Sachs up and, make a deal with them and negotiate the price and all of this sort of thing, and that takes time. What if I just want to do it? And that's what a dark pool is really for, is to be able to say, this is how much I need to sell, and this is like the price that I need. And then there's other guys on the other side that are providing the liquidity that are saying, if they're going to sell this much of it, this is the price that we have to give them and whatnot. And, it's a dark pool. They cross. Now that block trading firm owns this huge section of stock or whatever the deal is. What do they do with it? They turn around and they execute it on the market. and they're good at executing it so that the impact of it is less. So that the impact is less than, you know, the price difference that they got from the institution or whatever. And that's how they make their money, right? So though you're going to see that flow when that block trading firm comes in and moves it, right? And you could potentially front run that. You have some idea that it's coming. And I don't know if there's going to be like a fifth item or if there's other things that we want that I should include in there. Well, over the weeks so we're thinking about it, I can come in and add it. That's what that video is going to be about. We can do that one. And then we can make the video that trading combines are for suckers. It is. Yeah, I feel like I did learn something from this. Well, I learned two things. The first thing is I did learn why people are starting multiple combines. It's because your leverage on the larger combines isn't as good. But the other thing that I kind of learned is like, well, going from this assumption that like, if you're a profitable trader and you don't already have like $100,000 account, then you will probably make more money from doing the combine. But the problem with that thinking is you're probably not actually a profitable trader. If you've been trading on your own and you've been profitable for the last 5 years or something like that, then you wouldn't need the combine, probably. How did you become that good of a trader? You're trading your own money. You already have an account, right? So the combine ends up being for people that are still learning. And the whole thing is that it pushes you towards strategies that are super aggressive and are basically destined to blow up in your face at some point. So it really hampers your progress as a trader because you got to think of it as a filter, right? You're sitting here and you're like, okay, I want to make money from day trading. There's different strategies that I can use to do that. Well, which strategy should I trade? And then you say, well, I want to trade a combine, so I can only trade strategies that could pass a combine or that would make sense with the combine. And the problem is that all of the strategies that actually are practical and work and can make you profitable over a 5-year period don't make enough for a combine. They're too small and too slow. And or probably the big one involves swing trading, holding overnight and holding for several months potentially. Right? And so that's why I say they're for suckers. The whole thing is to sell you on this delusion that you're going to become a millionaire from it. The reality is that like of the people that really make any kind of meaningful amounts of money from that, there's probably 1,000 other people that paid into the fund, and that's how they're making their money. So it is for suckers. You're a sucker if you're delusional enough to think that you're actually going to be that guy that makes the money. And the guy that did make the money was probably just lucky, to be honest with you. With the way that the market is, like you get this Pareto distribution. This is the thing that I think is so funny about financial markets. You know, you get these Pareto distributions where like you get these guys at the very top and they hold more wealth than like everybody else combined, sort of a thing, right? And you come in and you say, well, there's a Pareto distribution with traders. So what gets a trader into this spot? And I would argue that like if there's 10 traders in that area where they've really made real money, I'm gonna bet that like 7 of them were just lucky. Seven of them were just lucky, and if they continue trading long enough, they will eventually blow up too. So many of these like interviews and things like that I've seen of really big traders, a lot of them it's like they got really, really big because they were lucky, and then they blew up, and they were just able to stop before they lost it all. And that's how they're still able to have a decent amount of money. There's a lot of guys like that. Like there's this guy, like I should watch that again. There's this documentary about floor traders, and there's this one guy that, like, you're in his house and it's a really nice house, and he is just the guy they're interviewing is so drunk, and he's like, people don't understand, like, if you're down on a position, add more, and if you're up, just let it ride. Just let it ride. Like, the way that he says that and everything, it's like, you were taking on risk and got lucky for a really long time. And then they ask him, like, okay, but why don't you trade anymore? And he's like, interview over, so you don't get to hear it. But I guarantee you that what it was is he was taking on big risk. Like, okay, if you're down on a position, then you double down on the position, right? Yeah, he's taking on massive amounts of risk. And at some point, he had a losing streak. And it was just, he quit before that losing streak was so bad that he lost his house and all of this other stuff. That's what happened. And that's a guy that's, like, clearly a millionaire from taking on risk. Well, taking on risk is, I guess you could say, taking on risk is an edge. It's just not a very good long-term one. What are you really trying to accomplish here? Because if your goal is, like, what's the maximum amount of money that I can make in a year, then by all means do that, right? But if your time frame is anything more than like 5 years, then right. Okay, have you ever looked into quantifying clustering phenomenon? Yes. So kind of depends on what type of clustering you're talking about. Like, if we're talking about clustering of volatility, for instance, there's a little bit different from how you look at clustering of orders per se, although they are still related and stuff. But I think that the more interesting one is like order clustering. Like, you're sitting here and nothing's going on, and there hasn't been any orders. And then you see one order come through. The chances of you seeing another order come in after it is like higher. And they can kind of go in and look at it and say, like, overall, here you have, like, there's all the trades, right? And then you can say there's this average. And, like, there's a certain point at which the number of orders has been below the average for so long that there's a really high probability that, you know, orders come through at that point, right? And they call this a Hawk's process, I believe is what it's called. So you can search for that, or you can just read about it in Trades, Quotes, and Prices, Financial Markets Under the Microscope. And that book also goes into why those phenomenons exist and why the clustering effects of volatility exist, like from an empirical standpoint. Because, like, again, volatility clustering is a behavior of markets that is different from what a pure random walk would be, that institutions take advantage of in their strategies for profit, right? So if there's this way to make money consistently from the market, why does that exist? Because we think that markets are efficient. Well, they're not, but why not? And what causes volatility clustering? Well, because a lot of the price movement ends up being endogenous. It's just people get stuck in positions and have to move the market, and orders have a really strong impact on things. And you'd think that, well, it's not in line with the fundamentals, so the market should just ignore that. But it doesn't work that way. The orders have an impact anyways. And, you know, if one person is blowing up, then, like, other people are likely to be blowing up, and you get volatility clustering. Let's see here. I saw the 2-year flipper and a couple of other guys with seats switched this week from the strip to grains. Really? Wait, so am I understanding that you saw they were trading grain markets? That would maybe make sense to me, though. Like, I think that if you're playing the CTA game, that you're looking really closely at commodities right now. Because the conditions and everything seem really prime for commodities to blow up at some point, to really take off. Hasn't happened yet. But kind of those favorable conditions still seem to be there. And especially if, like, you get a Democrat president, you know, then I really think you could see commodities continue to take off and everything. They said bonds have gotten too hard for scalping. Well, I you know, I feel like that bonds have been quote unquote too hard to scalp since like 2010. Like, you know, like, again, one of the edges that you can have on an intraday basis is market making. Market making is a competitive thing. There's only so much business out there, and so it's first one to the hit. And robots beat you to it, so it's kind of too hard to quote-unquote scalp / market make. Again, like, that's the whole thing, is like, I think that a lot of retail day trading is a cargo cult. So we watched these documentaries and videos and stuff when we were kids, showing day traders in the 80s and 90s making tons of money from doing, you know, whatever they were doing. And the problem is that the things that they were doing have been replaced by robots. They're 200 lot traders. Suspender syndrome. Totally. I was like feeling a little bit of a breeze on my face, so to speak. That the fan that I have on my camera. I guess I didn't turn the when I film and it's recording, it makes the camera even hotter. So I need to turn the fan up. So I probably should turn it down so I don't feel it in my face. There are many more millionaire traders today than there were back then, and I'm not thinking of those fake Twitter ones. Well, okay, but so I think we have to be really specific, right? I bet you that there are more millionaire day traders in the 80s, or relative to, like, on a population adjusted basis, than there are today. Like, you might be able to say that there are more millionaire day traders today than there was back then, but, like, there's more traders overall, the market's larger overall, and so you have to you know, you have to do it per capita. Okay, so I think there were more millionaire day traders in the 80s per capita than there are today. Now, there are probably more millionaire traders overall today than there were back then, because once you get outside of the intraday time frame, it's a different thing. Okay. Because in my mind, if I take a position and I hold it like 9 months, you know, that counts as trading in my mind. It's a long-term trading, but, you know, anything that's different from buy and hold in my mind is trading. And, you know, you could have taken an options trade that, like, really blew up, right? And then you're a millionaire. And, you know, there's those sorts of things. So, yeah. The biggest limitation, like, that's one of the things that bothers me the most, is that, you know, like, with my own trading, is that I came in and I was like, well, I want to day trade, I want to scalp, I want to do all of these sorts of things, and then go and do all of this stuff and realize that, oh, you know what? Like, that's, if you want to really make money, that's like the worst way to go about it, right? Probably not going to make money if it's day trading, because just the day trading itself is making it more difficult for you. You have a easier time. You swing trade. Swing trade. If you swing trade, I mean, the reason why most people don't swing trade is because they don't have the capital, especially swing trading futures. But if you had the capital to swing trade futures, I bet you would make money from it. Even if the strategy that you were doing was kind of dumb, you would maybe not make as much money as if you put that money in the S&P 500, but I bet you would make money from it. Okay, random question. Is trading random? And if so, does consistently profitable happen? So, consistently profitable can happen. The kind of like the benchmark for me is 5 years. So, like, if you were day trading and you made money every year, had to pay taxes on it every year for 5 years, then I can say you're a profitable trader. Okay. Could you do that randomly? You could do that randomly, but it'd be very, very unlikely. Very, very unlikely. So once you get to those people that they've been successful day trading for 5 years, now you're talking about people that really do have an edge. Okay. That's probably like less than 1% of the overall traders that try. Okay. And even if you go down to like people that consistently trade for more than a year, right? I think it's probably still less than 10% that actually hit that 5-year mark, and you know that I would say consistently profitable. So it drives me crazy when you go on Reddit and they're like, I'm looking for consistently profitable traders that have been profitable over the last 6 months. This means nothing, man. I can't tell you how many like back tests I've done where it's like, okay, I'm going in and I'm looking at it and it looks pretty good over like my test period, because this is just like me. I have an idea of what the trade is supposed to do and how it should work, and I do it and I test it. And I don't adjust any parameters or anything like that so that I have concerns about overfitting. But I look at it and it's like, oh, actually, this has done really well over the past year. And so I focus on that one because the results over the past year that I'm getting look good, right? And then you zoom out and you find out that 1 year period is like the only time that it ever worked. Can't tell you, like, so many like that. It's actually really easy to find a systematic strategy that is profitable over a 6 month to 1 year time period. Really easy. But to find one that's profitable over a 5 year time period, almost impossible. Especially if it's day trading, right? So it's possible, but it's very difficult. And why is it so difficult? Well, because it's a zero-sum game and it's competitive. So, like, if you're making money, you're making it at the expense of somebody else. Where you can find that advantage? Okay, so there must have been another Israel headline.
Block sell.
Oof. Wow. Man, anybody that just bought it there on that probably just got very unhappy. Although it may have just been the same guy buying it and selling it. Oof. Anyways. Okay, so where does edge come from? Well, we can look at things that we know can be an edge. Market making on an intraday time period. Market making can be an edge. Arbitrage can be an edge. Being an informed trader can be an edge. The first two of those, robots essentially dominate. So what's the option that's left that we know of? Being an informed trader. How often are you going to be the informed trader that knows something that the rest of the market doesn't? It's possible. It's totally possible. And I really enjoy doing that process and trading that way. Okay. But it's hard. It's not very often when you find that. And even when you do find that, like, there's so much other noise in the market and everything that sometimes even if you have the edge, it's not going to work out for you, right? So That's kind of the problem. Now, could you find some behavior in the markets that people aren't already aware of and that will make you money? Oh yeah, absolutely. It's just like, where is that going to come from? Do you know that there's like, what caused the quant crash back in 2018, I think it was that you had these firms, they would take these robots and they would just say like, here's how a moving average works. Here's all these indicators and different ways of trading and everything. And then they would just tell the algorithm, okay, like just run back tests and change yourself every generation until the robots constantly trying every variation of strategies possible until they found out what was optimal. And what happened in 2018 is a bit like basically they all blew up at the same time. Right. And then now those kinds of that kind of trading in the industry isn't very popular anymore. Right. So what are you going to find that those robots haven't? If you're just coming in and you're adding lines to a NinjaTrader chart and all of that sort of a thing, probably you're not going to find it, to be honest with you. You're going to have to be like a world-class statistician that knows math that like nobody else does and has the ability to like really innovate the space in a unique way to find an edge like that. I'm not that guy. I wish that I had gotten more into the statistics. That's something that I think I could have done, but I didn't know that's what I wanted to do until I was too late. Let's see here. I swing demo account, the ESCFD index, and a Bahamas broker with 100 leverage, and if you can get in with the trend and take some heat, you can... Oh, I bet. Oh my gosh. 100x leverage. That just sounds crazy. I agree. That's why I don't really back test. I just get ready to adjust my expectations from month to month, quarter to quarter, the thing. Yeah. I mean, backtesting is still really useful because backtesting can potentially tell you things about the market that people have already learned and help you understand those better and how to take advantage of those better. So I think that the programming is like a valid. Otherwise, I wouldn't teach about it, right? And or waste my time myself doing it and selling indicators and all of that stuff. It's because there is a benefit to it. It's just like, unfortunately, it's not an explicit edge. Man meat, wasn't that just overfitting then? Yes and no. I think that the quant crash was more than that. Because if it was just overfitting, why would they all blow up at the same time? I think that what was happening was okay, so they've done these kinds of studies with agent-based models where they'll have like a bunch of different trading strategies, and the trading strategies that are working at the time, they will reproduce or trade larger size, and the trading strategies that don't work eventually leave the market. And what they tend to find is that like it will be a really chaotic system, and then everything will kind of go towards one particular way of doing things, like one strategy. It gets too big and then it completely collapses. And so I think that the quant cat crash was kind of more of one of those natural cycles where, you were like on steroids because you had all of these algorithms constantly iterating and competing against each other, right? Eventually it's just going to come to a situation where they all kind of do the same thing and screw up. So I think that's what it was. But I think that I would say, I wouldn't necessarily call it overfitting, but I would say that like what they were doing was not a long-term edge. Maybe. So that's where it kind of gets kind of crazy, is that like I say, if you can find something that's profitable over 5 years, right? Well, if it's profitable over 5 years, you might be able to like do fundraising off of it and convince people to let you manage their money. But there are strategies out there that work for 5 years and then stop working, right? So you're not necessarily in the clear just because you cleared the 5-year fence. Jay Schwinn, if you see the leaderboard on Jigsaw, you see many people making money on day trading. Yeah, but the Jigsaw leaderboard doesn't show you a 5-year history, right? There's somebody who's been on the leaderboard for 5 years and profitable, and I'd love to talk to them. But it's something that I've found when I used to watch that leaderboard very closely and kind of was able to get an idea about what they were doing and everything. The guys that are doing that are taking on lots of risk. Again, like the best short-term edge, like if you just want to give yourself the best probability of making a ton of money in a short period of time, take on a lot of excessive risk, guys. Just take whatever, all of the dumb things that people tell you not to do, just do those things. Oh, I hate it when you guys retract your messages before I'm able to see what you said. That can be very deceptive, Jay Schwinn. Okay, so you're looking at somebody's equity curve, right? And, you know, like they posted on Reddit or something like that, right? And their equity curve looks like this, okay? That person is actually more likely to be the next guy that crashes. Right, because what you're doing is, here's a normal distribution. What you're doing is you're pushing in on this, and you're saying, all of these losers, I actually want them to be winners. So here's your little line, here's the break even. Here's my finger where I was pushing it in. I'm pushing it in so that there's more stuff over here, right? And what is the consequence of that? When you push a bunch of them over here, there are just as many data points that end up getting pushed out over to here as well. You get this far left tail. And what does that look like on your, you know, your equity curve? It's like going up like a straight line, and then all of a sudden, goodish. So if you go in and you look at the Jigsaw thing, and like, you know, every month they don't have a really big drawdown and they consistently seem to be making money and everything, you'd think, oh, well, that must be really good trading. But again, it's like, do it over 5 years. Because what happens is this period right here is like 2 years. It works for 2 years and then it blows up. That's what usually happens. Now, you could potentially trade like that, right? As long as you have a way to avoid this. So if you understand the market enough and you have the emotional capabilities and everything, you can see that this is about to happen and stop trading and just avoid it, right? So that the drawdown becomes this, right? But that almost never happens with retail traders. Like, the problem is that, like, even this might be too big for your account. So most retail traders blow up. But you could make it work if you were like a prop, not a prop firm, but like a hedge fund or something like that, right? Okay, so this is all this stuff that Nassim Taleb talks about, right? Because his whole irritation is that you have all these people, they say, oh, well, this works and this works. And he's like, well, yeah, because you're only looking at it over a short enough time period. You're not getting enough data to see the fat tail and see that, like, you know, LTCM is destined to blow up eventually. They didn't use enough data. If they had used enough data, they would see that this strategy actually is a bad strategy, and that's why nobody really tried to replace LTCM. So what he says is you actually want something with more variability. You want something that does this. That, you know, you have periods of profits and periods of losses, and there's a decent distribution of it, and over the longer period it tends to go up, and those are going to be the ones that like actually consistently bring money to you. See, isn't it so devious? It's almost like the entire system is designed to draw people into strategies that really aren't good for them. So much so that even the large institutions fall for it. And who's making the money meanwhile? Guys that know. The guys that know that, like, Congress is about to change this law that's going to make this certain company more profitable or less profitable. The guys that know that, you know, Israel is about to strike Iran in an hour. They, you know, those are the ones that are making the money, man. And the people that are like the CEOs and officers of the company, they get the shares. The people that are like the angel investors that get in early on the companies, those are the people that make the money. And all of this other stuff is so that there's enough noise for them to do their thing. The market exists for them, and we're all just noise to allow them, you know, give them the stage to make their money. But you're not actually supposed to make money from it. That's why the whole thing is set up to convince you to do things that don't really work. And always be delusional enough to think that you can make it work. That doesn't mean don't trade. That just means, like, be really smart about it and don't have unrealistic expectations. You think I should clip the last 5 minutes? Really? I mean, I could do that and make it a TikTok or something. You know what? Like, the thing is I made a bunch of videos talking about this. That's the thing, is that I've made so many videos and like posts on Reddit and stuff talking about this phenomenon that the traders that everybody looks up to are that appear to be the most profitable and the most consistent are almost always just taking on excessive risk and are the next ones to blow up. And like, it never does anything. Like, they never do well. Those videos never do well. It's like people don't want to hear it, or the algorithm doesn't like it for some reason. Yeah, I still don't actually understand how you trade. I know you rely on intuition. Well, okay, so here is kind of the insight that I've been able to develop that maybe you can incorporate into your own trading, because that's really what you're asking, right? It's not just like, how does Seth trade, but like, oh, could I do it too? Here's what I do. Okay, the key insight that you want to have is to understand that what you're really trying to predict is the orders. Okay, there's a lot of randomness in price. Market makers intentionally inject randomness into the price, but at the end of the day, it's the orders that determine what is going to happen, and more importantly, because there's limit orders and there's market orders, right? But those limit orders, a lot of that is liquidity providers doing arbitrage and whatnot against correlated instruments, right? So it's more so than just the orders, it's those market orders. We're looking for, there's going to be some sort of an imbalance. It's going to cause an institution or whatever to have to use the market orders and push the market in a certain direction. That's what we're trying to predict, right? So what we do is we take all of the things that we know that might potentially predict orders that day. So today, well, there was a NonFarm's payroll. That's going to cause a lot of orders. Well, it caused a lot of orders on the initial move, like a huge amount. So much so that it's kind of questionable how many orders might actually still be around to trade right now, which is what kind of why I don't touch it, right? Okay. But then there's also, it's Friday, so there are people that maybe had positions on all week. They don't want to hold it into the weekend, especially with the possibility that Israel might strike back at Iran. Don't want to hold it over the weekend, so they're going to exit those positions, right? That's another flow. There could be, there was the people that were hedging themselves against the potential strike by the port workers. Well, they've made an agreement on like a wage increase and have a cool off period so that like if there is another strike, it won't be until January. So that kind of has gone away, and there might be some people that are coming into the markets and making moves because of that. You just take every little thing that you can potentially know about a market that can reliably predict future orders. All of those things that I discussed right there are things that like we know. Okay, like I if I told you yesterday, hey, the non-farms payroll, the consensus expectation is 150,000, but it's actually going to come out to 248,000, right? I would hope that all of you here that have been watching me regularly would be able to reliably predict that the 10-year treasury would sell off of that. You might not be able to say like what price or any of that, but you would say that like the net orders, like the net change in cumulative delta that day would be negative, that people would sell, right? I could very reliably predict that that's going to cause orders. All of those things are things that you can reliably predict that they will create orders. Sometimes you might not know if it's going to be more buy orders than sell orders, but you know, you list all of those things out, right? And then you add them together. So you have the net imbalance of those things. And then you can determine at that point, once you've added them all together, if it's a big sell, then you go, oh, okay, so I want to sell today. That's what I do, right? So I'm looking for a situation. It's preferable that situation is like one where not everybody is going to be keyed into that there's going to be a huge imbalance today, right? Like situations where like it's the end of the month and portfolios are rebalancing and there's this, that, and the other things kind of all combined to a situation where there's going to be big sellers in the market today, and the retail traders especially aren't going to realize that. They're not going to realize that it's happening until like it's already basically happened, right? And so then I'm looking for an area where it's relatively quiet and I'm able to get a good spot in the order flow to take a trade and just try and hold it and see that expected imbalance come through. That's how I'm trying to trade. I discuss this if you go to speculatorset.com/strategy.html. There's a mailing list you can sign up for, and it will email you a PDF document where I go into great detail about this. Both the process that I'm doing and some of the things that I'm looking for that I know tends to predict orders. And we would like to make a video for it as well, but it's kind of like, it's a lot of detail to go into for a video, right? So. Is there a way to do for cars what they've done for .com and stuff, like candlesticks with live MSRP or something, or am I being dumb? Well, okay, so here's a question for you. I mean, this is like I love this analogy because it's one of those things that like really gets you thinking about like, what am I actually trying to do here? Like, especially if you're somebody that's like putting a trillion things on your chart and everything like that. Okay. So you were saying cars. How about, let's just be like a little bit more general. eBay. Okay. If you have a video card that you just upgraded your old video card and now you want to sell it, how do you decide what price to sell it at on eBay? Well, I don't know about you, but what I do is I go and I use their filters to filter it to completed auctions. And I look at the last time that video card sold, how much it was, right? And how many they were, right? And I'll look at that and I'll say, okay, well, but that was the 3 GB version and I have the 6 GB version, right? So then I have to compensate for that, right? I have to say, well, okay, so this one went for this amount, but it was the lesser version and that extra 6 gigabytes is worth $50, so I should price it for this, something like that, right? So what are you actually doing? How are people pricing things in most markets? They're looking at substitute assets and then quantifying the difference between those two assets to determine a price, essentially, right? So that's exactly the way that they do it for cars, right? So they say, okay, well, like a base Camry is worth this much, but then you have all of these options, and each of those options are worth this much. So this is how much the car dealership should be selling the car for, and they price it that way, right? This is arbitrage. That's the way that arbitrage strategies work, right? You come in here into the 10-year treasury, and then you go and you look at what the price of the 10-year treasury is on broker tech, and you say, well, except for that this is a future, which is slightly different, so I have to factor in the cost of holding the contract until it's closed, and so that means that I should price the treasury at this. And then if the treasury isn't being priced at that, then I have an opportunity to buy or sell it, and then buy or sell the asset on the other place, and arbitrage, right? There's no way on eBay to go and like pull up a price chart and be like, here is the price of this video card over time, and because there's a Head and Shoulders here, I should now be trying to buy it for less. And yet nobody does that. And I'm sure that you could get a chart to do that, but I bet you that the people doing that with the chart probably wouldn't be that successful with it, right? Like you might be able to see a trend that you maybe didn't see before, like that this asset is consistently moving up over time, and maybe that might be useful. And then what is that? That's momentum, right? Might not have, but the momentum that you see in financial markets might not carry over into other types of markets all the time. But like, that's the whole thing, is like, okay, what should this be worth? If I'm gonna say like there's a certain price and that's like the value price, and if we're above or below that, where how do I compare that to it? Well, that's the answer. You look at a comparable asset and quantify the differences between them. There you go. So yeah, you probably could make candlesticks on eBay, but I don't think there'd be much of a point to it. Bet you there is a website out there that does it though. Well, guys, I had fun talking today. See why you see what happened is I said what I wanted to say. That's why I feel good about it. Wanted to make more videos where I say what I want to say. But I got some, well, I don't know if I really, it's a Friday. The job search is good on Fridays. It's like who lists a new job on a Friday? I don't think very many people do. So, but I've got a video to edit, so we'll edit that video today. And who knows what else. I guess once I'm done editing that video, I will move on to expanding the order flow misconceptions video. And I don't know, I have some more interviews lined up, and I don't expect to be unemployed for very long. Hopefully we'll be, able to get at least 2 videos out before we run out of time, and or have a bunch of scripts up and ready so that, I can still record things over the weekend. Do it that way. All right, guys. I'm just blabbing now. I'll catch you Monday. Stay excellent.